from the Universidad Carlos III de Madrid, Professor Xavier Auberson, the Université de Genève, Switzerland, Professor Isabel Laventure from the Universidad de Montevideo in Uruguay. Thanks very much, and well, I welcome myself, Maximiliano Batista of the Universidad Torcuato di Tella. We will begin by the presentation of wealth taxes in each of our countries, followed by conversation or discussion about the possibilities of using wealth taxes for covering the extra expenses incurred by the governments due to the COVID pandemics. Diego, if you want to begin with your presentation about Colombia.
Hi, thank you everyone. I'm very happy to be part of this panel. Happy to work with you, with the ones that I've already worked with, and with those that I haven't, it will be a fortune to work with you here. In Colombia, we've had a lot of experience with net worth taxes, so I want to guide you through what we've experienced for this tax in our country. Essentially, what I want you to understand is that in Colombia, we've honestly tried every single iteration of the tax that you can think of. If you think of yourself in a regulatory context, Colombia can be seen as a real-life tax sandbox for wealth taxation. We've tried different subjective scopes, sometimes entities, sometimes individuals, even PEs subject to the tax. We've tried different tax bases, some of which are net worth, some are aggregated assets, some are partial and total exclusions. We've tried presumptive bases, variable bases, indexation control bases. We've tried different triggering factors, different thresholds, different periods. We've tried fixed versus dynamic triggers. We also tried different tax rates, flat rates, progressive rates, surtaxes, anything that you can think of, we've probably tried in the past century. So think of us that way. We started in 1937 with this type of tax, by the way. So again, it's been a tortuous long path with this tax in our case. Sometimes we've tried an extraordinary tax. Sometimes we've called it an ordinary tax. We've even called it a forced investment, if you can believe that. We've had it as a temporary tax, as a permanent tax. We have allowed or disallowed compensation with the tax in terms of personal and corporate income taxes. And we've tried various budgetary games. We've tried sunsets, sundowns, hypothecation, all sorts of figures. In terms of the meaning of the tax, the nature of the tax, the purpose of the tax, we've tried with fiscal and extra fiscal objectives, right? We've thought of it as a revenue generating figure, but we've also thought of it as a redistributive or wealth altering figure. We've also experimented with the figure as an inductor of productivity. We've tried various approaches to the tax, depending on the time in which the tax was in place. So we've used it as an emergency measure for natural disasters. We've used it for financing security needs. Many of you might be aware of the history we had with civil conflict. We've used it in the context. And perhaps the only constants in all of these variations is that it's always been levied at the national level and that it's always been modest as a source of revenue when you compare it to the other types of taxes. So that's something quite interesting, regardless of all the changes that it's had in structure throughout the almost 100 years that we've had it. It's never been a main source of revenue. It's always been rather tangential or marginal in the composition of the state's revenue. So instead of thinking of it linearly, this doodle here shows you that this tax in Colombia has had a non-linear trajectory. You started with a first period from 1935 to 1983, approximately, in which the tax was created and expanded. Then in 1984, as global economics shifted a bit towards orthodox economics, you started dismounting the tax, and we had a firm mandate to dismount it, and that was done in 1992, but it lasted briefly for a few months before we came back to the tax, and that's what I call the rebirth, and that's from 1992 to 2014. Eventually, we tried again to get rid of it, unfortunately, because whilst the tax was supposed to die this year, 2021, it doesn't look that way. And there's already a project in our Congress trying to give this tax a second rebirth. That's why I have it in interrogation signs, because we don't know whether it will be a reality in the future, but it looks like it. And that's what history tells us in this country, that whenever it's been called temporary, it becomes permanent. So that's something to be scared of when they're talking about temporary taxes in the COVID context. You don't have to read all this. This is just so that you see the main changes that we have. When we started the tax in 1935, we thought of it as a tax that was very much attached to the personal income tax. It covered pretty much all of the income for foreign and national people. It covered only the elements that sum to today's dollars, less than $200,000. It had an exclusion for shares, which is quite interesting. Even in 1936, we did have the idea that this was bad in terms of double taxation. So we had an exclusion for shares, as long as those shares paid tax. And we had exclusions for pensions and certain work income. It was small, it was progressive, 0.1 to 0.8%. And then, interestingly, it had huge surcharges for non-productive assets. So initially, our tax was seen as a way to boost productivity. And that was part of a wide context of agrarian reform. We wanted to make land more productive. And this was heavily influenced by what was happening in the US at the moment with the New Deal and FDR's 1935 Revenue Act, you know, the Rockefeller Tax Act. So then in the context of World War II, we had a special surtax, which was redeemable for public bonds. It was seen as a counter-cyclical measure, so we also have experience seeing it as a counter-cyclical measure. The taxes were increased during the war. And then after the war, we had an optional monthly tax base. You could choose whether you wanted to pay it in installments or whether you paid a single annual fee. But the shareholder exclusion was actually eliminated. That was quite unfortunate, if you ask me, but that exclusion then was reverted in 1960, and it was not only reverted, but there was another exclusion for unproductive assets. So the ratio of the tax was increased, the rate was increased to 1.5, but you had this exclusion of unproductive assets, which is quite useful and something that we really have to think about in terms of a COVID context. Eventually, the tax increased again to 2%. And then in 1974, we were having the results of a mission, the Musgrave Reform, IMF mission, which was Keynesian, and it wanted us to revert all of those exclusions, take them off, and start taxing shareholdings and unproductive assets again. So if you see it, what we had achieved in 1935, we then eliminated in 1974. Then in the second phase, when we wanted to start to get rid of this tax, we started reducing the rates in 1983, but we had a ridiculously complex system with about 200 brackets. Then there was a mandate for the executive saying in 6 months you need to get rid of the tax. That's in 1988. In 89, the mandate was amended and it said you can eliminate it provided you've established some sort of inflation indexation system for the assets in terms of income tax. And they started a main dwelling exclusion for the person's main dwelling, which I think is a shared tool in many countries. In 1992, we actually managed to eliminate the tax, but it lasted for a few months only. Then we started with something quite weird called the BDSI, which was a mandatory investment. So you had to buy public treasuries. It was equal to 25% of what you paid in income tax, but only for those with assets over a threshold. The problem is that these bonds, this mandatory investment, was not financially viable. It was not indexed. It did not pay a coupon, and it could only be used for paying taxes upon maturity. So obviously, it was declared unconstitutional. Fortunately, it was seen as clearly confiscatory. In this third phase, in which the tax has a rebirth, we had a lot of contextual difficulties. So in 1998, we had a very difficult security situation, which extended to 2006, and the tax was associated with investment in ramping up the armed forces, police, etc. So initially, you had an extraordinary tax. It was redeemable after 7 years in terms of forced investment, but this time it did have indexation, so it was allowed by the Constitutional Court. Then in 2002, you had an extraordinary tax. Everyone that pays income tax, there was no threshold, and we went back to the shareholding exclusion. It had a very weird element, which was a retroactive presumptive minimum base, and that part was ruled unconstitutional by the court. The rate was high, it was 1.2. Then we had ordinary taxes, both in 03 and 06. The threshold was higher, about $1.5 million. It did maintain the shareholding exclusion, but only for national companies and your main dwelling. And it started something of a dynamic tax base, meaning the tax was levied for 4 years, but you could adjust your base every year. Afterwards, you went back to a static tax base, meaning the tax base that you had in year 1 was applied in year 1, 2, 3, 4, regardless of your economic circumstances. Then in 09, we had an ordinary tax, which was progressive. It had very high rates from 2.4 to 4.8. And it had the same exclusions, but they added one for infrastructure projects, which again, in the context of COVID, is quite an interesting exclusion. Because under Keynesian theory, at least infrastructure projects seem to be the way to go, at least in the US, they're thinking that way. Afterwards, we had an extraordinary tax. It had special anti-abuse rules, which were declared conditionally constitutional. This was to prevent asset splitting between different companies owned by the same person. We had a special surcharge, low threshold. Afterwards, in the third phase, we had an ordinary tax, which was called the wealth tax in 2014, initially both for entities and individuals, afterwards only for individuals, and that marked kind of a decline. The idea was to eliminate the tax. It had similar exclusions, a special one for foreigners. So if you had lived in the country tax-wise under 5 years, you were not liable on your foreign assets. It had a dynamic control base, which is an interesting concept that's still in force. So that's a base that is adjusted every year by 25% of the consumer price index. And we had progressive rates. And we started using a lot of voluntary disclosure initiatives for offshore undisclosed assets. And it was not deductible for income tax purposes. The last one in 2019 was also an ordinary tax. It had an exclusion for portfolio investment for non-residents, except for assets held by PEs, which was something introduced in 2014. And you had favorable treatment for assets that were disclosed and repatriated. I've seen that in the Argentina concept, you have this idea of repatriation as well, but not necessarily under disclosure. So that's quite interesting. We kept the dynamic base, that is the base controlled by consumer price index. And we kept the exclusion for main dwelling, the person's main dwelling, but not for national shareholdings. It was a single rate, not progressive rates. And the idea was that the tax would be eliminated next year. And it was also a hypothecated tax, which is unusual. It didn't go to the central tax burst. It was used only for funding agriculture projects. And it was non-deductible. And this last iteration of this horrible maze is the one that we are proposing in the current tax bill. And it's called the temporary and solidary tax of wealth. I mean, like I told you, you have to be aware of the temporary. Nothing is temporary in terms of taxes, really. because it creates fiscal path dependency. It's like a cookie jar. If you see the tax is there, it's very popular because you can say it only triggers taxation of the wealthy. Chances are it will be there in the future. Whatever's temporary will remain permanent. At least that's been the case in Colombia, clearly. So the idea is that it will only cover individuals. It will not cover entities. 1.5 million threshold, slightly lower than other countries. Definitely not what I would call a tax for the wealthy. $1.5 million is something that in Colombia you can easily have just through real estate for your dwelling, even with the exclusion. It also covers foreign entities and Ps, but only under Colombian holdings, with an exclusion, which is that if what you have in Colombia is all through shareholdings or through portfolio investment, you are not taxed. The idea here was not to damage the country's competitiveness. We have the main dwelling exclusion. It's increased partially, but we do not have a shareholding exclusion. We have an exclusion for normalized repatriated assets, again, in the context of voluntary offshore disclosures. Progressive rates, 1% and 2%, but the 2% threshold starts quite high at 4 million. We do have the dynamic control base, meaning it's only the base of the last year, plus or minus 25% of the CPI, either in an increase or in a decrease scenario. And what's new is that you can deduct it from the personal income tax, which is weird because it should have always been the case. But for many years, we did not allow deductibility of this type of tax. So I just want to show you very quickly what has happened in terms of revenue. Here you can see the green arrow, the green bar is the combined revenue of wealth taxes, which is red, and blue, which is tax on net worth, when it's been called that way. As you can see, it's never been huge. At its largest, it was less than $2,000 million per year. So not much at the moment. It's only about $300 million per year. Very, very little, in spite of all the changes. So when it was big, it was when you had entities and individuals in the tax base, in the tax triggering factors. But when you only have individuals, which is what they're proposing, it's quite small. And if you look at it comparatively in this other chart, compared with the other sources of income, tax income that the central state has, income tax, VAT, even our financial transactions tax, it's tiny because it's the green one. See, it's absolutely tiny, even smaller than the financial transactions tax, which is the purple, and far, far smaller than the income tax and the VAT. So as you can see, it's never been a main source of revenue, and its revenue generating potential has always been quite modest. So I think that's what I wanted to show you about the Colombian scenario, and then we can discuss the economic parts in the latter part of the presentation. Thanks.
Thank you very much, Diego. Very clear and very, I would say, depressing regarding so much efforts for so much hindrances and so little revenue. Marilyne, if you want to follow with your presentation about France.
Yes, sure. I'm going to share my screen. Maybe here. I just would like to, because I have not a very good connection. So I'm just going to turn off the camera during the presentation, and after I'll come back again visually. Okay. So good afternoon to all. I am very glad to be here with you today, and I would like to thank Professor Maximilio Batista for his invitation to be part of this panel. También me gustaría darte las gracias en español porque vos siempre me escribiste en francés y te prometo que la próxima vez intentaré hablarte en español, lo que me va a ayudar a progresar. Muchas gracias.
Muy bien, felicitaciones. Muchas gracias a vos.
So I propose to start my presentation on wealth taxes in France with a quote. You can't tax people, when they earn money, when they spend money, and when they save money. This quote is attributed to a French economic professor, winner of the Nobel Prize in 1988. And he described himself as both a liberal and socialist theorist. And all his work focuses, in fact, on the need for a tax on capital that balances fairness in the distribution of wealth. This is the socialist theory, and with efficiency in the production of that same wealth. And this is the liberal part. This quote, I have chosen this quote because I think it's interesting for two reasons. First, it implies a choice to each state to define what a capital tax means. And for this reason, wealth taxes are not resistant to political and economic changes and are subjected to great legislative instability. And this is particularly true in France, as we will see in a few minutes. Secondly, it questions the objectives of a wealth tax in a category of the capital tax. And in France, this category is not very clear, as we can find a different kind of taxation depending on whether the capital is owned, transferred, or taken into account or into consideration the nature of the assets. And in addition, the economic crisis caused by the COVID pandemic has brought the question of whether wealth holding implies an additional ability to contribute. So in France, for the general overview, this general overview is characterized by legislative instability, as I mentioned just previously. Although there is a very ancient history of taxation of land and property in France, the first modern wealth tax appeared in 1945 under the title of National Solidarity Tax, which was temporarily introduced to pay for the exceptional cost of the war. So it was therefore a typical crisis tax. After, it was not until 1981, with the election of the left-wing party, that a tax on large, this is the key words, on large wealth was created with the idea of making the richest pay to reduce inequality. At that time, few people were concerned. A fortune is said to be large when it exceeds the equivalent of 450,000 euros and is taxed at a progressive rate. Here, it is an objective of tax justice and redistribution of wealth that predominates. The end was acted in 1986 when the right-wing party won the elections, as the prime minister decided to abolish the tax in order to stop capital flight. After that, nothing until 1988, because the left-wing party won the presidential election and introduced a solidarity tax on wealth. Solidarity is the important word here, as the tax allows the financing of a minimum solidarity income paid to the poorest. Then a major reform was carried out in 2011 under the presidency of Nicolas Sarkozy from right-wing party, with a reduction of the solidarity tax on wealth in order to compensate the abolition of the tax shield he introduced in 2007, according to which a taxpayer cannot be taxed at more than 50% of his income. Immediately, to compensate the alleviation decided by Nicolas Sarkozy, President Hollande, left-wing party, upon coming to power in 2012, and decided to create an exceptional contribution on high incomes. This contribution is interesting, as it gave rise to a constitutional decision giving a kind of a method to determine when the tax is confiscatory on the ground of the ability to pay principle. And finally, President Macron decided to abolish the solidarity tax on wealth to create a tax on real estate wealth in order to finance the real economy while maintaining the exceptional contribution on high incomes. So I'm just going to focus here on the change and the reasons for the change in 2018 by presenting the two models, the old one and the new one, because in fact they have a lot of things in common. So I would like to briefly give you the main principle of the old solidarity tax on wealth, as many of these principles have been taken over in the new one. Concerning the taxpayer, only natural persons are concerned on an annual tax base, and covering the entire wealth of a tax household. This broad tax covering immovable and movable assets explains why this broad cover, why this tax had in practice an indirect impact on businesses, since many companies or groups, managers hold shares that can be considered as professional assets. These professional assets benefits from an exemption. For residents, worldwide income was taken into account, whereas for non-residents, it was only on a territorial basis. There was a threshold for the application of taxation from an amount of net taxable wealth, which was around at the beginning, around 610,000 euros when it was created, and has remained at 1.5 million since 2011. If this threshold is reached, the progressive scale applies from 800,000 euros of net wealth since the reform of 2011. And as you can see, the tax brackets have varied greatly over time, but it was always comprised between 0 and not more than 2%. Many exemptions were applicable, and the most important one concerned the qualification of professional assets. In addition, we had some specific exemptions for non-resident and impatriates, and also for antiques, art objects, collection items, forest, etc. And finally, in order to limit the tax burden of taxpayer, different mechanisms were created, such as the tax shield previously mentioned, and a cap on the wealth tax. In fact, this cap, it was in order to prevent wealth tax from being confiscatory. The wealth tax plus the income tax due cannot exceed 75% of the income of the previous year. So the interesting question now is why in 2018 we have the end of the old wealth tax, even though this tax brought around 5 billion euros in 2017. 4 main reasons are mentioned. The first one is in terms of competitiveness, attractiveness. The maintenance of a wealth tax in France drives capital away to other countries, which have progressively abolished this tax, and leads to a decrease in state revenue. And a lot of commentators said that the overtaxation of capital leads to the disappearance of wealth creation. Secondly, as regards productive investments, this wealth tax discourages investments in the productive economy when it would be better to encourage investments in the real economy to promote economic growth and employment. Then in practice, there are bypass mechanisms that lead to significant reductions for some taxpayers with very large wealth. Thus, the richest are not necessarily taxed, mainly because they use exemptions to circumvent the tax in order to optimize their personal situation. And finally, one of the primary objectives of the tax is not reached, that is the redistribution. This idea of a redistribution from those who have more to those who have less has not worked. And there are many exemptions which lead the richest not to be taxed. As a result, the tax did not reduce inequalities because the tax provision allowed the very rich to avoid paying it. It is for all these reasons that the creation of a new wealth tax has been decided by the Finance Act 2018, which created the real estate wealth tax, which is applicable as of now. I will go through this slide very quickly because as I have mentioned, the common rules derived from the old version are applicable to the new one, and they are all on these slides. I just would like to focus on the most interesting question, that is, what are the changes in fact? So I'm just going to, go here. What are the changes? The main differences is a change in philosophy with the idea of a restriction to immovable property only. So we excluded all movable property. The tax base is limited to real estate or real estate rights held directly by individuals, as well as shares in companies, regardless of their legal form and location. In practice, there is something very complex, as one has to go through the ownership structures to check whether the real estate is held through a company, through a life insurance, or a trust, for instance. To ensure that the real economy is favored, only real estate are not used for an operational activity can be taxed. It means that if it is used for professional activity, it is excluded. So we can find the same logic than before. Secondly, there are specific rules for the deduction of debts, and a precise list is given by the law. The idea here is to limit the deductible debt to those related to the taxable assets, the immovable one, and a distinction has to be made between the taxpayer debts and debts of a company owned by the taxpayer. Some measures have been put in place to cap the deduction, in particular for the most important assets, capped at 5 million when they exceed 60% of the value of the real estate assets. Sorry, for the I restart. Capped at 5 million euros when they exceed 60% of the value of the real estate assets, unless the taxpayer can justify that they were not contracted for mainly fiscal purpose. This makes it possible to control the deductibility of debts and to introduce anti-abuse clauses or to limit the tax interest for loans. And the idea, in fact, the general idea is that there should be a limitation or a prohibition of deduction where the deduction may give rise to a tax advantage that is considered excessive or artificial. If certain specific exemptions remain for this type of assets, immovable assets, notably for their professional character, some new measures have been introduced. For instance, a 30% deduction for the main residence has been introduced, and also for the very minority partners holding less than 10% of the capital or voting rights of a company engaged in a professional activity, there is a total exemption. A practical question very quickly arose, that of the application of the tax treaty of the new wealth tax. The question was resolved by a reply from the Minister of the Economy, who specified that the conventions relating to the wealth tax and future taxes of an identical or similar nature are applicable to the new one. However, it is not very clear in practice all the time. And finally, to compensate for the restriction of the tax base, a specific flat tax has been created for dividends at a proportional rate of 30%. Previously, before with the old tax, these dividends were included in the income tax, which is progressive. The last question to be addressed, 3 years after the introduction of the tax, where do we stand? What are the consequences? Firstly, I have to say that it brings in much less revenue than the old tax, even though it is higher than expected. It brought 2.1 billion in 2019, and it is stable since then, whereas the old one brought around 5 billion euros, so we have a gap. 2 reports were published. The first one is by the French Senate in 2019, which states that taxation of real estate assets alone leads to an anti-redistributive effect. The reform leads to a total exemption of very high financial assets and to a concentration of the tax gain. In practice, almost 2/3 of former taxpayers have been exempted from the new wealth tax. The observation is therefore that the new tax has made it possible to totally exempt a large proportion of very wealthy taxpayers because they had little real estate assets, while a large proportion of former taxpayers remain subject to the new wealth tax without having very high incomes. So it is the first statement. The second one is that some economic inconsistencies of the reform have been stated. First of all, the real estate inflation observed since the end of the 1990s had led to taxpayers who could hardly be qualified as rich being subject to the former tax, simply because they own real estate whose price has increased significantly, and it is the case with the new tax too. And secondly, it can be added that the objective of stimulating investment is not certain, in particular because the new tax base is not based on the distinction between productive and unproductive assets, but aims solely at taxing non-professional real estate assets. Today, we have very complex provisions that create uncertainty for taxpayers, because in the new model, a lot of space is given to the anti-abuse clauses in order to make sure that the wealth tax is paid. Thus, certain provisions aim at preventing strategies to circumvent the new tax and give the taxpayer the possibility to prove that the purpose is not primarily fiscal. And in practice, this search by the tax administration for the taxpayer motives has a questionable subjective dimension. The argument that the old version was the cause of certain departures abroad is not confirmed, and the fraction of the tax gain reinvested does not seem not to fully benefit French companies. So we have some uncertain consequences at that time. And finally, an important effect of the reclassification of labor income as dividends can be noted. Indeed, as dividends are less taxed, this encourages the taxpayer to switch part of the remuneration from wages to dividends. So it's an observation that can be made. The second report was published last year by the National Assembly and specifically concerned the exceptional contribution on high incomes. It indicates that the word solidarity is the most important. The first statement, and maybe the most important one, is that financial assets are important. The movable capital of the rich mainly made up of financial assets with higher returns than regulated savings. So taken into consideration these difficulties, new proposals have been made. The reintroduction of the old version of the wealth tax, the abolition of the flat tax on dividends, which mainly benefits high income earners, and the increase of the rates applicable to the exceptional contribution on high incomes to increase the progressiveness of the tax systems. Other topics can be discussed, but I already spoken too much, so thank you very much for your attention. I'm going to turn off my camera.
Thank you very much, Marilyne. It was a very, very interesting presentation. Well, now I give the word to Frederik Zimmer. Frederik.
Thank you very much, Maximiliano. Norway has had a net wealth tax as long as we have had an income tax. That means from the second half of the 19th century. It has been remarkably stable in its structure, and as you understand, it has not at all been triggered by the pandemic. The wealth tax is closely connected to the income tax, and the original rationale for the wealth tax was the view that capital income had more ability to tax than earned income. So there could also be a tax on the capital itself. That's, of course, is not the reason for having a tax now, but I will come back to the recent discussion. I should mention that Norway also have a real estate tax, which is levied by the municipalities if they want to do that, and between half and 2/3 of the municipalities do that. And for taxpayers, I believe that the estate tax is more burdensome than the wealth tax, actually. We used to have an inheritance tax, but that was abolished as from 2014. The wealth tax is both a state and a municipality tax. That hasn't had much to say through the years, but recently one municipality in northern Norway decided to reduce the wealth tax considerably in order to attract rich people to settle down there. And that has created quite a lot of debate. but it doesn't have a big practical impact. The revenue of the wealth tax is expected for 2020 to be around 15 billion Norwegian crowns, and if you divide by 10, you will arrive roughly at the number in US dollars. This means that the wealth tax is about 1.2% of the total tax revenue, which is not very much, but not insignificant either. I can also mention that the expected revenue from the real estate tax to the municipalities is at about the same level as the wealth tax. The taxpayers in the wealth tax are individuals, not companies. Companies was taxable for wealth tax in the early years up to sometime in the 70s when it was abolished, based on the view that amounted to double taxation of company capital. So we tax shareholders, but not companies. Tax rates for the time being is proportional, and it's 0.85%. 0.85%. There's a threshold of 1.5 million Norwegian crowns, which is only 150,000 US dollars. So you see that's a low threshold, and this means that this is also a tax on the middle class. But one important aspect in this perspective, I think, is that owner-occupied dwellings, which I will come to later, are valued very low, and most of the middle class have their wealth in their owner-occupied dwellings. So in fact, they pay, for that reason, less wealth tax than they otherwise would have done. The tax base, internationally, it is paid on the worldwide taxation of residents with a credit method to avoid double taxation. For non-residents, real estate and tangible assets in Norway are included, but not shares and other financial assets. And that's an important point which I will come to later. The tax basis is a net base, which means that you have deductions for all your debts. It's a comprehensive tax base for tangible and financial assets, and it includes both business and private assets. But there's one important exception, and that is that most intangible assets are excluded from the tax base. And this includes, for instance, goodwill, patents, know-how, trademarks, and copyrights. And the only reason for this is the valuation problems connected with such assets. But as you know, these type of assets are maybe very valuable these days. So this is really an important exception from the tax base. And as you see in a minute, it creates some problems. Then I come to the valuation, which is really a crucial issue in a tax like this. The main rule is that assets should be valued to their market value. But of course, there are difficulties in reaching the market value in practice, and there are also some exceptions. Traditionally, real estate has been undervalued, both private and business real estate. In the later years, however, business real estate has been valued closer to their market value than before. But however, owner-occupied dwellings, houses, are valued at around 25% of their market value, which is, of course, a big exception from the main rule. And nevertheless, the debt on such houses are fully deductible. And similar rules applies to vacation houses. As for shares, listed shares are, as a point of departure, valued based on the stock exchange value. But unlisted shares, their value is calculated on the basis of the taxable assets of the company. So we go through the assets of the company, and from that reach a value of the shares. And this means that the exceptions from the taxable assets, the exceptions from the tax base for instance, intangible assets, will be reflected into the value of non-listed shares, because as I said, this is based, the valuation is based on the assets, taxable assets of the company. And since intangible assets is excluded, they will not be included in the value of the shares in the non-listed companies either. And this creates a problem because the value of because the valuation of limited shares, of listed shares and unlisted shares may be very different, because for listed shares, of course, the value of intangibles are reflected into the stock market value ordinarily. And this in turn means that when a company is planning to go to the stock exchange to be listed, they may experience that there is a very substantial increase in the taxable value of the shares. And in practice, we have seen that this makes unlisted companies reluctant to get listed. And it also been an effect that main shareholders emigrates, often to Switzerland, by the way. As a result of a political discussion in the later years, there has been a reduction of valuation of assets belonging to the so-called working capital in business. And from this year, these values are reduced to 55% of the value set according to the principle I just outlined. This applies to shares, both listed and unlisted, to real estate in business and other fixed assets and goods in business. And as a consequence, the deduction for debt shall be restricted accordingly, according to schematic rules. And now we reach the current debate. The wealth tax has, in Norway, as everywhere, I think, been hotly debated. The Labour Party and other parties on the left of the political spectrum are in favor, strongly in favor of the tax, mainly because it makes the rich people pay taxes. These people, and mainly the very rich, turns out to pay relatively little in income taxes, but they really have to pay the wealth tax. For the Conservatives and other parties leaning right, the problems for business, and in particular for SMEs, is important. To pay the wealth tax, shareholders often must get money from the company, even if the company have losses. And this money is, of course, first taxed as dividends, and you can use the rest to pay for your wealth taxes. And this drains resources from business, even if the wealth tax is not a tax on companies. It is, however, disputed how strong this effect is in practice. Another argument is that the rules, as they are now, often discriminates investors who are resident in Norway. And this is because shareholders resident in other countries are not liable to wealth tax in Norway, because shares are not included in the shares owned by non-residents are not included in the tax base. And there is normally no wealth tax in the resident country of the shareholders. So they are not hit by any wealth tax, and that is said to discriminate Norwegian investors. Even if Norway has had a center-right government for almost 8 years now, the wealth tax has not been abolished, which the Conservatives originally promised. The argument that this tax really makes rich people pay some taxes has had an impact also on the Conservatives. Instead, the government shifted tactics some years ago and lowered the tax on working capital instead, as I have explained above. This is a controversial concept because what is working capital? If you ask economists, they will say all capital is working, and you will have problems with drawing a line around such a concept. We will have a general election this fall, and as it looks for now, there will be a shift in the political power. The center-left majority will probably have a majority, and we will have a new government. They will probably roll back the favorable rules on working capital, and probably also increase the wealth tax rates generally, but not very much. Yeah, that's of course very difficult to say, but some increase can be expected. And the rationale for this is not actually the need for more revenue to pay for the pandemic problems, but it's rather a discussion about equality. The wealth tax make rich people pay taxes, and that's the main reason why it's still in force. Thank you.
Thank you very much, Frederik. It's a very interesting description of Norway, which is, by the way, a fairly unknown reference for most of us. So this is very helpful. Well, now it's Violeta's turn. Violeta, thank you very much. Go ahead.
Okay, I'm trying to share this. Can you see it? You can see the presentation, can you?
Yes.
Okay, thank you. I'm just changing my. Thank you very much for the invitation and for this opportunity to have a bit of a discussion about wealth taxes or wealth net taxation. In my, I think, 10 or 15 minutes, let me set the timer here. I'm going to tell you a bit what we have in Spain, some of the legal issues that have arisen, and the current level of the discussion. Now, okay, the tradition of the net, of the impuesto sobre el patrimonio, of the net wealth tax, it was established in 1977 as an extraordinary tax. I have to say that Spain is a late comer to a modern tax system. We didn't really have a system, a tax system as such until after the death of dictator Franco, and after the Spanish Constitution was approved in 1978. In fact, if you're curious, I don't have the chart here because I didn't want to have too many slides, but if you go to the OECD tax database, you will see the jump in tax pressure in Spain in those years. And that is one thing that is remarkable, because tax pressure actually mounted about 30 points in less than 10 years. And yet there was no general revolution, I have to say. And this is one of the few things that I am actually proud of my country. I am very critical of many other things, but in this respect, I think probably Spaniards in that time understood that a tax system is what you pay for having a democracy. It comes at a price, and it means you have citizens that pay the taxation. Now, the original idea in 1977 was to have a zero-rate tax to control personal income taxes. I point that out now because that's an idea that has actually never been fully abandoned. The reason why we still have a net wealth tax in Spain is because it provides very useful information on personal income taxes. Now, I'll leave this idea here, and this is a history of the tax in a nutshell. I'm leaving a lot of information out, but basically it starts by being temporary extraordinary tax. Then it's reformed in 1991, which declares it a permanent tax. Then it is reformed on different occasions, basically to make sure, the most important reform is to ensure that it only taxes individual personal wealth that has nothing to do with business income. So there's a number of exemptions. I will name some of them, not all of them, because I wouldn't have the time to do that. But basically, those they ensure that this is basically a tax on idle assets, on wealth that you're not really putting to work. So in that regard, it is a liberal tax by nature. So if you have wealth, you should put it to work at some point. Now, it's suspended in 2008 by a socialist government, and it's reintroduced again in 2011 by a right-wing government in the middle of the crisis, but only for a couple of years. Then it's extended again and again. So it becomes, since 2011, the tax has been sort of validated each year. Recently, in December 2020, the tax was declared permanent by the budget law, and it was also substantially increased, and it has been, for the first time in Spanish history, it has been challenged before the Spanish Constitutional Court. Now, I do not really know all the grounds for the claim of unconstitutionality. They're not public. What I know is what I've read in the press. But one of the reasons is that it would be, it would have a confiscatory nature. That's the rationale, what they're saying, because interest rates are so low. So basically, you're taxing wealth that is not really yielding any revenue. That would be one of the arguments. Now, the structure of the tax, you can see it in this law. I have shared the presentation with you. And by the way, feel free to share it with anyone that wants it. I'll send it to them. It's very basic. Taxpayers are only individuals, never corporations. There are a number of rules for non-resident individuals. Now, some of these rules are probably not consistent with European Union law, but I'll leave it at here because otherwise I will just go into another direction. There are a number of exemptions. They have different rationales. There are some exemptions that have to do with proven artistic or historical heritage. Others have to do with personal, sorry, there's a typo there, personal items. Basically, it's too difficult to value and assess personal items. And there are other exemptions that have to do with economic activities. Now, my connection is a bit unstable, so I'm just going to stop my video. I just had a message point out to that. Now, there are a number of exemptions, assets and other participation in family offices and family homes. Then there's a default limit, and there's a general minimum exempt of 700,000 euros. So all in all, it's designed, and this is the default regulation, is designed to be a tax on wealth for middle upper class. You still have middle classes. Now, it's always had another thing that I want to point out is that the law has always had embedded in it a coordination rule with personal income taxes, so that the accumulation of wealth tax and the personal income tax doesn't actually, it's not too much. It's not higher than 60%. This has to do, it wasn't motivated by the German Bundesverfassungsgericht case law, but it's the same rationale, it's the same argument, just a different origin. The tax basis is the net wealth of individuals, and one of the most difficult areas, one of the areas that cause the most problems in practice is that the law has specific valuation rules depending on the type of asset. So you've got specific rules, especially for the main asset, that people who have wealth in Spain, their main asset is always going to be real estate. So you would think that we're pretty good at valuing real estate because that's what we have. That's where Spaniards invest their money. Well, we're not. If you look at pending cases before courts, you'll see that that's one of the huge area. There's a number of reasons for that. Basically, the law establishes a number of different values, objective values, assessed values, dynamic versus static. And it has to be assessed on a case-by-case basis. There's, these are the tax rates. There's a progressive, this is the current default rate since 2020. It has been increased for net wealth of 10 million euros. Sorry that this is in Spanish. I didn't have time to translate it, but I just wanted you to have the general idea. It can get to be quite high, especially if you take into account that, what I said before, that people who do have wealth, most of it will be real estate wealth. I have about 5 minutes. Now, one of the, if I had to choose what are the pending issues, what is the current status of the situation, one of the things that you have to take away from the wealth tax, net wealth tax in Spain, is that it is delegated to autonomous communities. It means the central government actually shares the tax with autonomous communities. Now, from a constitutional perspective, the central government could always take that power. That's what the Spanish Constitutional Court has said. Of course, from a political perspective, that is never going to happen. What happens in practice is that some autonomous communities, namely first Valencia a few years ago and then Madrid, have actually in practice suppressed it. So one of the proposals that was put forward in a general report on the reform of the tax system in 2014 was to actually just do away with the tax. Not just because there's so many differences among autonomous communities, but because there's so many legal issues that have to do with correctly valuing the taxes. In fact, we don't know the exact number, but it is relatively easy to evade the tax, which actually means that it's a very unequal tax in practice because of how much avoidance there is. Now, the control role of the tax is one of the elements that keeps it alive, but of course, the databases that we have now, the data controls that we have now are much more sophisticated than what we had in the 70s, so that control role is probably losing support. One of the other proposals on the table is to transform it and increase the minimum exempt. Just very briefly, I'll let you know that you have a general chart on how much revenue Spain has in a normal year. Now, this is 2019. 2020, as you can imagine, tax revenues have plummeted. Sorry, this is 2018. But I just wanted to give you a very, very basic rough estimate. Now, the main taxes of a system, this is, you have to add, of course, you have to add 6 zeros here. So this is billion euro we're talking about. The main taxes are personal income tax, corporation income tax, value-added tax. Now, net wealth tax yields about one euro a year, which in terms of how much revenue there is basically 0.5%. Now, if you look at Spain, you'll see that this is what we call the public database of wealth in Spain. You'll see that wealth is concentrated in Madrid and Catalonia, also in Basque Country and Navarra, but this doesn't show it because they do have different systems. So there's an estimation that if Madrid actually did have a wealth tax, then it would actually yield of the tax or revenue of the tax would be 100% more. So what's the current situation of the discussion? And I'll finish with this. Well, the current situation of the discussion is that the truth is that the tax doesn't really yield much, but it seems like to some people, it does seem like a bad moment to eliminate the tax, because actually it would be an exemption on the highest echelons of the society in a moment where we had the crises that, of course, everybody knows what happened. So right now there's a commission to reform the tax system. One of the things on the table, one of the elements on the table is what are we going to do about the wealth tax? So we're going to be looking into all the other examples. So thank you again for inviting me and for giving me the opportunity to learn a bit more about the rest of the systems. Thank you very much, and I hope I didn't overstay my time. Okay.
No, thank you very much, Violeta, for accepting the invitation. Spain is always a reference for us, and this was a very interesting and clear description. Xavier, this is your turn now. Please go ahead.
Thank you very much. Thank you, everybody. And it's always great to be able to speak around the world. I'm here from Switzerland, and it's amazing with the quality of the video, and we can all discuss about this wealth tax. And thank you for the invitation. So I would like to describe a little bit the Swiss system. So for that, I will just try to share with you the PowerPoint. Yeah, I hope it's okay. You can see it.
Yes.
Okay. Slideshow. I think this is the one. No. Yeah. Sorry. Just put the screen. Voila. Okay. So yes, I will describe the Swiss wealth tax. You know that Switzerland has a reputation to be a low tax country. In some aspect, this is true. But surprisingly enough, we have a wealth tax, in fact, and we have that tax since decades. But it's only a cantonal tax. So to have a clear view on the Swiss system, you should see that it's a federalism system. So we have, in fact, 3 levels of tax in Switzerland. We have the federal tax. We have then the cantonal tax. So Switzerland is divided by 26 different cantons. And in fact, the competence of the canton for tax purposes is very important. And then within each cantons, we have municipalities, which also have some power to tax. So in order to really understand the Swiss system, which in fact is a bit complex because of that, you need to see these 3 levels of tax. So the wealth tax is, in fact, it's only a cantonal tax. You don't have it at the federal level. And it's an important tax for Switzerland because it was one of the main source of income for the canton. And it started at the last century. There's, as far as the jurisdiction to tax is concerned, so the tax is due by any person who is resident of Switzerland, and then it will be the canton in which this individual is resident, which is competent to levy the tax. And it's also applicable to non-resident person who have either real estate in one canton or have a permanent establishment in one canton. But there's a big exception, which is not in the slide. So I just want to be clear at the beginning. And it explains also why Switzerland sometimes is viewed as a favorable country for example, high net worth individuals, because there's an exception, and this wealth tax is not applicable for individual under a so-called lump sum system of taxation. In French, it's the famous forfait fiscal. So under this regime, you have an exemption from the wealth tax, but otherwise it applies in general. So what happened is in Switzerland is that since this tax was a pure cantonal tax, there was a big competition between the cantons, and even very different regimes among these 26 different cantons. So can you imagine? It's a small country, Switzerland, but we had like 26 competing regimes, and it created a lot of competition, a lot of controversies, and the Supreme Court had to render many cases in the past. So in order to alleviate this competition and to clarify the system, there was in the year 2000 a very important federal law, which is the Federal Harmonization Tax Law, which entered into force in 2001. you could view this law in a way like a EU directive, because it's exactly the same mechanism in the sense that it is a federal law, but it forces the Swiss cantons to implement their income and wealth taxes with the same main element, the definition of the taxpayer, the tax base, the valuation, and the timing. And this applies for the wealth tax. So in a way, since this Federal Harmonization Tax Law, we have the same system in the whole Switzerland. And the only remaining aspect for the cantons is the applicable rate. So you have 26, in fact, different tax rates in Switzerland because we have 26 different cantons. But otherwise, the essential element of the wealth tax are the same in Switzerland based on this harmonization tax law. So another important aspect to see is that we have under the federal constitution, and it was also discussed by some presentator before, we have the right of property, which is viewed as a constitutional right. And according to court cases, the Supreme Court cases in particular, this guarantee of property includes the protection against a so-called confiscatory taxation. So, of course, the wealth tax could be sometime, if it's too high, and if in addition to the income tax, it creates a too big burden on the property, it could be viewed as a violation of the guarantee of property and notably of the protection against confiscatory taxation. So in order to find the right balance, as you will see, the cantonal law have introduced a mechanism which in fact is a copy, I think, of the French mechanism, which we call it the tax shield, le bouclier fiscal. And this wording, I think, is really a copy of the French system, which was also mentioned and described before. So then the justification of the wealth tax is controversial in Switzerland. And really, to summarize, there are really two different views about this wealth tax. So some people say that this wealth tax is potentially detrimental because what we can see is that high net worth individual, for example, if they cannot benefit from this lump sum system, they are subject to tax on their worldwide asset, and they can move from one canton to the other, and it has happened already, in order to alleviate the tax burden, or they go abroad. We see Swiss residents going to Monaco, but not even Monaco. They go to Italy, which have a favorable regime. They go to England with a so-called resident but non-domicile regime. And now they even go to Portugal because there's also a favorable regime. So there's a problem of competition among the state with this wealth tax. The second aspect is that so some people argue that, and it was mentioned before, in fact, the income has been subject to tax, and then it's again subject to tax as a capital tax. So the opponent of that regime, they argue that. And also for some cantons, like for example in Geneva, the rate of 1% is regarded as too high. And if you think about it, there was like a hidden increase of such tax, because when the law was drafted, you could consider that it was easy to get a 5% income from your asset. If you invest your asset in a bank, at that time, let's say 50 or 40 years ago, you could get a 5% rendite, for example. And now you have a 0%. And in Switzerland, if you think about it, we even have now negative interest if you invest in Swiss francs. So now the rate of tax is regarded as very high because it's 1% for assets which sometimes have 0 or even -0 income on them. So Then we have the people that justify it. They justify the wealth tax based on the principle of ability to pay, because they say, well, you have an asset. This asset represents an ability to pay. And also another argument in favor of that tax is to say, you may know that in Switzerland, the private capital gains are exempt from tax. So this is a justification for the wealth tax, because if you have a capital gain, you are not subject to tax. So as a sort of substitute for that, you could tax the wealth. And finally, some people argue in favor of the wealth tax based on the principle of progressivity of the tax and solidarity. Right now, the tax is in force, and frankly speaking, I don't see any proposition in order to abolish this cantonal tax. Also because this is one of the last remaining exclusive competence of the canton. So politically speaking, it will be very difficult to obtain the approval of the canton. And another aspect that you should take into account is that in Switzerland, we have a democratic, a very strong democratic system in which people are required to vote very, very often. And in the tax matter, it's always at least a referendum could be asked in tax matters. If you change the rate of any tax in Switzerland, you can ask for a referendum. So if we were to abolish the wealth tax, you would have a referendum and people would have to vote. And it could be, I think, difficult right now, also taken into the difficult situation with COVID and etc. and the pandemic. I think the time is not the right time to come and with a proposal to abolish such tax. On the contrary, in fact. The only very delicate aspect under my personal view of the wealth tax is that it is also levied in Switzerland on commercial assets. In French, you have this word outil de travail, which in fact doesn't exist in French law, but it exists in Swiss law. And in my view, this is a detrimental tax, which doesn't make so much sense because the commercial income, including capital gains, are always subject to income tax in Switzerland. And therefore, the justification on wealth tax on that part is a bit problematic in my view. So then I don't want to bother you with details on how the tax is levied. I just want to mention that it's a global tax on the net asset. So you take the whole asset minus the debt. There's only one particular exception on home furniture and personal goods. And there's a controversy about art goods, but in the canton of Geneva, in particular, there's an exemption, which is, again, the influence of France, I think. We exempt art goods based on cantonal Geneva law. And this was rather controversial, but it's still in force today. Then the taxpayer is the owner of the wealth. We have a complex rule in case of trust. You may refer then to my slide. And the last aspect I want to mention is that for the valuation, it can be quite complex because the law requires that we compute the wealth of a taxpayer in accordance with the market value. And what is the market value? I mean, we could talk about this for the whole afternoon. Huh? So in order to find a solution for the market value, for example, for some goods that are difficult to evaluate, there was a lot of studies, and there's a sort of methodology that has been defined by a group of experts in Switzerland, especially for stock shares of companies which are not listed. And we call it the so-called practitioner method. It's a practical method trying to evaluate this wealth. So in summary, the system of Switzerland, I think, has worked not so badly. And the only problems that we have faced is the problem of the possibility of an infringement of the right and the protection against confiscatory taxation. And for that, we have introduced a tax shield, which is based in cantonal law. And the tax shield, which is, again, under French influence, is that we add the income tax and the wealth tax, and this amount of tax cannot go beyond 60% of the net income tax, but this is just for cantonal tax purposes. Then the rate of tax is different from one canton to the other. The worst cantons are, as I said, Geneva, Jura, or Neuchâtel, where you get close to 1% of the tax. But in some cantons like Schwyz, Nidwald, or Obwald, which are Swiss-German cantons in the center of Switzerland, the rate can go as low as 0.2%. So it's to no surprise that some high net worth individual happen to reside in these remote cantons, but most probably this is for tax reasons. So this is basically what I can say, and then I'm ready to discuss later on about the question you may have. So thank you very much.
Thank you very much, Xavier. And very interesting presentation. Thank you for the connections you have made to the case of France. This shows that really ideas go back and forth between neighboring countries, and they are really a source of inspiration, which also allows interesting comparisons. Well, Isabel, this is your turn for Uruguay.
Thank you. Good, well, afternoon and morning as appropriate to everyone, and thank you to the panelists for the presentations that have so far been very interesting to listen to. I'll try to share my screen and devote the next few minutes to discussing the situation in Uruguay. I'm not good at sharing the screen, sorry. Just tell me when you... Are you able to see it now?
No.
No? I always have the same problem. I'm really sorry. I don't know what I do wrong. Okay. Okay, doesn't matter. I'll just... Okay, basically, if I can't share it, it doesn't matter, because it basically had just a few details for me to be able to speak to you today. In terms of tradition of net worth tax in Uruguay, the story is not as convoluted as Diego shared for Colombia. It's oddly enough, it's similar to what we discussed for Norway. We've had the introduction of net worth tax in '67. With basically the same structure as we have today, with the difference that in 1967 it only applied to individuals and to certain local corporate entities and foreign entities. But since '96, the application of net worth tax was extended to all local corporate entities, and we had a very widespread tax reform law in 2007. One of the main goals of this tax reform was the reintroduction of a widespread personal income tax, which we hadn't had since the 60s, and the simplification of the tax system. At this time, whether the net worth tax for individuals would be abolished or not was discussed. In the end, net worth tax was maintained with basically the same structure. I would say essentially the same structure and tax rates for corporate entities. For individuals, the tax rates were lowered and most importantly, scaled down over time. The rationale at the time was that there were concerns because of this introduction of personal income tax that there would be double taxation implications, and so that was addressed with the reduction of the rates and the scale down. But as Violeta mentioned, there is this notion that net worth tax has a control function over personal income tax, and that was one of the main reasons why it was kept in our tax system. So when we talk about net worth tax in Uruguay, these are essentially two separate taxes for individuals and for corporate taxpayers. The taxable basis is different, the rates are different. But one thing that both taxes have in common, or both categories of net worth tax have in common in Uruguay, is the affiliation to the territoriality principle, which has been a basis of the Uruguayan tax system in general. But in the, I would say, in the last maybe even 10 years now, Uruguay has been deviating from the territoriality principle, or the source principle for income tax, but still net worth tax only applies to assets that are located in Uruguay. Assets that are located abroad are not taxed. This is not to say that they are not relevant for net worth tax purposes, because the liabilities that you are able to deduct are the amount of deductible debts that you have that exceed the value of assets held abroad and of other exempt tax assets. And so for a Uruguayan net worth taxpayer to have assets abroad may impact their ultimate net worth tax liability. Because this is another particularity of the net worth tax for individuals, and that is that it's basically a tax on assets, because the only deductible liabilities that individuals can consider for the computation of net worth tax are the debts that they have with banks or other financial institutions. That's the only liability that they can deduct, and that is why this limitation on the consideration of assets abroad is not typically relevant for the determination of the taxable base for individuals. It may be more relevant for corporate taxpayers because they have a wider array of deductible liabilities. They can essentially deduct not only bank debts, but debts that they have with supplier, other debt instruments that are not issued by financial institutions, and tax debts, provided that they are not matured. As I mentioned, Uruguay has been deviating from the source principle or the territoriality principle in the last decade. In 2011, we amended the tax reform law to tax with personal income tax certain foreign sourced capital income. At the time, the party that was in power, that was in the executive branch, was a leftist leaning government, and the bill of law that they originally sent to Congress also modified net worth tax rules, and these assets that would generate foreign sourced taxable foreign sourced capital income would also have to be considered for net worth tax purposes for individuals. in 2011, the party that held the executive branch did not have the majority that they needed in Congress to pass this law, and as part of a political compromise, the net worth tax remained unchanged, and so we only changed sourcing rules for foreign sourced capital income, but we didn't change the territoriality principle for net worth tax purposes. And that is interesting because the players are essentially the same now as they were 10 years ago, with the exception that the people that were in the executive branch in 2011 are now in Congress, and in a few minutes I'll tell you what they are trying to do now as a response to COVID. There is a non-taxable minimum for individuals, not for corporate taxpayers. The non-taxable minimum for 2020 is approximately $115,000. That's for fiscally adjusted assets. This non-taxable minimum is set by the executive branch on a yearly basis. It's dynamic, but it's essentially adjusted yearly on the consumer price index variation. Because of the valuation rules of assets for individuals, this non-taxable minimum implies that essentially the rich pay personal net worth tax in Uruguay. It may not seem as a lot, but there are several specific rules of valuation of assets that make it so that a person with a significantly larger net worth than this non-taxable minimum still remains untaxed. Just for reference, the whole of net worth tax typically represents 5% of the tax authority collection. 40% is income taxes, both corporate and personal income tax and retirement taxes, and 55% is indirect taxation. VAT is still the main revenue collection source in Uruguay, which is somewhat different of what we typically see in other countries. As I said, the tax rates for individuals are being scaled down since 2007. Currently, there are only two rates. One is 0.2%, the other is 0.5%. It applies on tranches over certain amounts of the non-taxable minimum. This is only for resident individuals. Non-resident individuals still have to pay. They are taxpayers for net worth tax in Uruguay, but this scale down of rates did not apply to them, so they still have the same rates that we had in 2007, which is over tranches rates that go from 0.7% to 1.5%. Okay. Corporate taxpayers have a flat rate of 1.5%, with the exception of banks and other financial institutions. They have a special rate, a higher rate of 2.8%, but in turn they are able to deduct all liabilities that they may have. Another interesting aspect of net worth tax in Uruguay in terms of tax rates is that non-resident entities as well as individuals have to pay net worth tax if they have assets in the country. And if these entities are incorporated, domiciled at, or resident of what we call LONT, low or no tax jurisdictions, and have no PE in Uruguay, the net worth tax rate goes up to 3%. If they have a PE in Uruguay, then they are treated as a local corporate taxpayer, and they have the 1.5 rate. This LONT jurisdiction list was originally of approximately 72 countries. It's been shortened and shortened by the tax authority yearly. It's today it's about 40 countries which are in this list, which it's supposed to include essentially countries that are not compliant with the standards in exchange of information for tax purposes according to the international standards. Okay. Finally, the response, or what happened in terms of net worth tax and COVID-19 in Uruguay. We had the first case of COVID in March 2020. In April 2020, the government created the COVID fund. This was a fund destined to cover the government expenses that derived from the pandemic situation. When you say the government, is actually required a law. The executive branch sent a bill of law for Congress for approval. The current government does have a majority in Congress because they were elected on a coalition basis, and the members of the coalition have sufficient votes in Congress to essentially pass any law, no matter what special majority is required. And so they passed law 1980-74 in April 2020, where they created the COVID fund. And notably, the COVID fund was formed with the creation of an extraordinary interim tax, not a net worth tax. It was a tax on public servant salaries over a certain threshold and up to a 20% rate. This covered not only elected officials, but also all public sector employees, even the employees of the state-owned utilities and other companies. The only exception was health workers, because the government understood that they were on the forefront of the combat to the pandemic. It was not appropriate to tax them at this time. This law allowed for 2 months of the application of this interim tax, and the executive branch was allowed to extend its application for another 2 months, which it did. And then in April 2021, 1 year later, this interim tax was reintroduced for another 2 months, and with the option by the executive branch to extend it for 2 additional months. The President Lacalle, has been vocal in that the government has no intention of amending net worth tax rule as part of the COVID-19 relief package. And I say this because, and this is also very particular, the president took to holding we at times weekly, sometimes on a fortnight basis, sometimes monthly press conferences where he announced he discussed the sanitary situation, and he announced himself any measure that would be adopted. And these press conferences were also open to questions. And in the end, it was a very usual question at the end of these conferences, whether the government was considering amending net worth tax rules, essentially to tax the assets held abroad, because of this notion that we had since 2011 that there were significant assets held abroad by Uruguayan residents. They were there. Now there's, for the last decade, these people have been paying income tax over the income from these assets. Why isn't it the time to make them pay over the assets themselves? The president said that he didn't feel it was the time, that it was part of his campaign platform not to increase taxes, and that he intended to keep that way, and that he was confident that these people would invest the money that they have in the Uruguayan economy, and that was the way that they should contribute. But nevertheless, there is now a bill of law that has been presented to Congress by Frente Amplio senators. This is the party that was in the executive branch before the current government took office in last year. The intention is to boost the COVID fund. The bill is drafted by the former Vice President and Minister of Economy, Danilo Astori, and it does not amend net worth tax rules in paper, but in essence it does. It creates an extraordinary one-shot asset tax over deposits, loans, and capital or debt placements in foreign entities at a 2% rate. The bill says that the non-taxable minimum for individuals that exists for net wealth tax purposes would apply, except in the case of current net worth taxpayers who just would have to add these assets and pay this specific, this extraordinary one-shot asset tax. As Maximiliano said earlier on, that the possibilities of this being actually enacted as law are low, but this has put this issue definitely in the press, and it has been brought to the attention of the public whether this is a measure that makes sense, should be adopted or not as part of the COVID-19 package relief. So I think that what was I wanted to share with you today as this part of the presentation, and of course we can discuss in whatever time we have left. So thank you very much.
Thank you very much, Isabel. Again, a very interesting presentation. So I think this is my turn, but first I want to check. So Xavier, can you turn your camera on so that we take a group picture of the panelists? And so, yeah. And now I'll shift to my presentation. Thanks. Share. Here, Argentina has known the wealth tax as an alternative to the estate and gift tax. Actually, wealth taxes on individuals evolved from estate and gift taxes. Actually, the first wealth tax in Argentina the official name was the tax in substitution of the estate and gift tax. And then some some avoidance schemes appeared, mainly by shifting assets to companies and by having the shares being transferred on death, which were shares without a name. And so the wealth taxes on corporations were created to prevent individuals from attributing assets to corporations. So that's the origin of the wealth tax. It is, as has been explained in other cases, a control measure in order to obtain tax revenues from what used to be a state and gift tax. Besides, the anti-avoidance system was for the government very useful because it took as a tax basis the picture on a given day, which was generally December 31st for individuals and the end of the fiscal year for corporations, which meant that the tax was very easy to collect and the tax basis to determine. Argentina used a territorial tax system until 1991. And when it shifted, well, actually the personal assets tax was the first one to shift from a territorial tax system to a worldwide tax system. And also there was another difference that until 1990, 1991, the tax basis was net worth, so that liabilities could be deducted from the tax basis. And another change was that they could no longer be deducted. So in those 2 years or 3 years, it changed from a net worth territorial tax system to a assets worldwide tax system. Well, why? Well, basically because liabilities made the tax basis smaller, and that was not good for tax revenues. So it made it easier to have only assets as the tax basis. Who are the taxpayers who pay these taxes? Well, for many years, there were 2 taxes, one for individuals and one for corporations or legal entities. And there was a short period of time in the 1990s, a 3-year period between 1996 and 1998, in which only individuals were subject to this tax because the assets tax on corporation was abolished. It was reinstated in 1998, and it has been abolished again in 2019. So nowadays in Argentina, you only have an assets tax on individuals. Of course, there are some cases in which some entities are deemed to be individuals. One of these cases are foreign entities who are shareholders or partners of Argentine companies. Why? Because it is considered that individuals abroad who want to invest in Argentina would be subject to this tax, and it would be very easy for them to do it through a special purpose vehicle, and so not paying this tax. foreseeing this maneuver, the law equates foreign entities to individuals for shareholding of shares or other stakes in Argentine companies. Argentine trusts are also subject to tax. Why? Because trusts do not have shareholders. So if you structure a tax in a way that the tax not that the settlor of the trust is no longer a beneficiary or cannot revoke the trust, he could say perfectly well that he no longer has that those assets, but the beneficiaries may not have those assets either, because they are not part of the trust agreement. And so putting assets into a trust could be an easy way to avoid this tax. Foreseeing this, the law equates, doesn't really equate, but it also subjects to tax Argentine trusts. I have to say that Argentine trusts are not a very common thing, but they can. But the law provides rules for them. Tax bases, as I already said, are on assets held on December 31st every year, and liabilities are not taken into account. There is one exception, which is debt incurred for the acquisition of the place of abode, the homeowner dwelling that we mentioned before in other countries, but with a limit which has not been adjusted for inflation and therefore is fairly low right now. Trust with local settlers and foreign trustees. Well, I mentioned before the case of local trusts, which may be used for avoidance purposes, but they cannot be used for that because they are considered to be a taxpayer as well. Foreign trusts have pose a more complex problem, because if trusts are are created by the settlor, and the settlor is no longer the beneficiary, is not the beneficiary, the trustee is outside Argentina, the assets are outside Argentina, it is practically impossible to find a connection between the trust and Argentina for tax purposes. And the settlor can perfectly well say that he no longer has any ability to pay on the assets of that trust because he has totally divested himself from them. And that's more or less the case. It has not been tested yet. There was a case under previous law, which is the Eurnequian case. It's a Supreme Court case for many things, but not for personal assets tax, in which the case was limited at the level of the Court of Appeals, which basically says that trusts on which the settlor has no control should not be included in the settlor's tax basis for personal assets tax. Then the non-taxable minimum. As you can say, in Argentina, the personal assets tax has a non-taxable minimum of about $20,000, which is fairly low, and covers many middle class and also, of course, upper class people. What Argentina has done to mitigate this effect on the middle class is to exempt the place of abode, which is generally the most expensive item in a middle class household. So the place of abode has been exempt since 2018. tax rates. Argentina has different tax rates depending on the location of the assets. Assets located in Argentina are subject to lower tax rates than assets located outside Argentina, which is, of course, an incentive to bring financial assets located outside Argentina into Argentina. As you can see, the rates are fairly different at the lower levels, and there is not much difference in the rate. It's 0.5% for assets located inside Argentina compared to 0.7%. So it's about 20 percentage point. No, sorry, 0.20 percentage points. But at the top levels, the difference is between 1.25% and 2.25%. So that's 1 percentage point. And you can see the top level, the top tax rate is for total taxable assets in excess of $180,000. So as you can see, still a fairly low threshold for the top tax rate. The option to be subject to the local assets tax rate for all the assets is to repatriate 5% of the financial assets abroad. This takes us to one issue, which is the valuation, which has been mentioned by many of you. How are assets valued in Argentina? Well, real estate in Argentina is basically valued at the fiscal value, which is what the government says its value is. And most bonds in the market are valued at the market value in the stock exchange. Shares are valued at the percentage share at book value, the percentage of the book value of the shares. So that's especially for non-listed companies is a fairly low value because it doesn't include the goodwill that the company has generated. I must say also that holdings of shares in Argentine companies, regardless of who the taxpayer is, are taxed at the lowest tax rate, which is 0.5%. And the tax is not paid by the shareholder, but by the company issuing the shares. There are some tax exemptions. I have mentioned already the place of abode. Government bonds are exempted, national, provincial, and municipal bonds, and not foreign government bonds. Savings accounts and certificates of deposit in local banks are also exempt. Annuities in local insurance companies are also exempt. And these three exemptions are clearly designed to promote certain type of investments. Local insurance companies have very strict rules of investment, which generally means government bonds or local companies, local productive companies. So it is an indirect way of promoting investments in this type of assets. Intangible assets are exempt historically, mainly because problems of valuation, which is, I think, the same case as in other countries, that they are not subject to this tax. And rural real estate, this is a recent exemption. It used to be exempt from personal assets tax, but subject to another type of assets tax, which allowed the income tax to be used as a credit against it. This structure was abolished in 2019, but rural real estate kept its exemption from personal assets tax. The rationale for this is mainly because it is considered that its value is too big compared with the revenue, the income that it yields for the owner. Well, how about the status of the personal assets tax? It is a temporary tax, of course, but no longer believes that. It has existed since 1991 in its current form, and it has existed for many more years in a different way. Talks about abrogating it have existed from time to time, but they have never been implemented. How about the tax rates? Well, this is a model shows that until 2015 it was 1.25%. In 2016 there was an idea of phasing it out until its total disappearance, and it turned out that it was only phased out for 3 years, and the idea in 2016, or what the law said, was that it would remain at 0.25% as a flat rate. But since 2019, it was sharply increased to 1.25% for local assets and 2.25% for foreign assets. And then, as if this were not enough, we had an extraordinary tax on wealth enacted by Congress in December last year on assets owned by Argentine resident individuals on December 18, 2020, and also on assets owned by non-resident individuals in Argentina. This is a one-time tax, at least that's what the law says. And this really covers rich individuals with assets above $2.5 million approximately, with no exemptions. This was atypical because generally taxes do have exemptions, and this tax does not have it. And the official purpose is to obtain resources to finance the response to the COVID pandemic. Actually, it's not even called a tax. It is called a solidarity contribution. But the law itself shows that it doesn't mean much about, doesn't care much about the COVID. Only 20% of the revenue shall be used for medical equipment, vaccines, etc. And more than 20%, 25%, shall be used for, will be given to the state-controlled oil and gas company, YPF, for new projects. And regarding tax rates, they are far higher, from 2 to 3.5% for local assets and from 3 to 5.25% for foreign assets. With the repatriation option, but in this case it's not 5% as in the case of personal assets tax, but 30%, what is required to be repatriated. Argentina has elaborated the National Supreme Court the confiscatory the non-confiscatory right, so that a tax may not be confiscatory. This is an interpretation of the protection of private property in the national constitution. The first case in which a tax was found to be confiscatory was decided in 1911. It was an estate tax. And that case, Rosamelo de Canet still holds. Estate tax have been found confiscatory if about 33% of the transferred assets. Then in the 1940s, the National Supreme Court resolved several cases regarding provincial real property taxes and a few ones regarding trade taxes. And in this case, it applied the 33% on the income that this property or business generated. First, the court said the real income, then said the presumed income, or what the income that should have been obtained according to normal management. That for real property taxes. The trade taxes, it always said the real income. In recent years, there has the prohibition of confiscatory taxes has been applied for income tax for the first time when Argentina was suffering an inflation process, and there was a prohibition for adjustment for inflation. That means that companies with important assets and few liabilities had fictional income, which would not have existed or which would have been much smaller in case inflation of adjustment had been applied. So the National Supreme Court in 2009, in a case that has a funny name, it's called Candy SA, because the company was a sweet manufacturing company, said that the prohibition of adjustment for inflation made the income tax confiscatory in the case when, if the adjustment had been applied, the tax represented 62% of the income of the company. The new confiscatory tax sparked a debate about whether the tax was confiscatory, and in case it was, how should that 33% or whichever percentage should apply. Well, it is too soon to say. There were a couple of preliminary injunctions issued by the first level courts banning or preventing the government from forcibly requesting the payment of this tax for 2 or 3 individuals, apparently based on the allegation that the tax is confiscatory. But it is yet to be seen how this percentage are calculated, because among tax practitioners there is also a lot of debate regarding how this percentage should be calculated. Well, thank you very much. And now we begin the debate. So I think, if I may make a general comment of what the panelists said, is that the taxes have some safety valves in our countries, which have allowed the taxes to survive. For example, one is how to value the assets. Because a low valuation allows the tax to survive with a seemingly high tax rate, for example. An exemption, for example, in the case of Argentina for the place of abode, allows for the survival of the tax in the case of a very low minimum tax, which would make it reach the middle class or even the low middle class, because it's only $20,000. And for countries, and of course there are some other issues, like, for example, the easiness with which taxpayers move themselves from one country to the other, and also when you have many assets in the international market, so to speak, in a bank account in one of the main financial centers, if you change your place of residence, you change very easily whether you are subject to the tax or not, especially because these financial assets are located in places where the tax does not exist. So, and now, well, this conference is a very good example of it is very easy to be in a place and be active in another place nowadays. The only thing you cannot change that easily is your real estate. So maybe that's why countries are so particular in taxing real estate as the main, for example, in France, as Marilyne said. But well, what are your thoughts about this? You're all muted, please.
I'm taking the liberty to start here. I just want to say a couple things. Like, in the current policy debates, generally what I'm seeing is that people agree that this is a suboptimal tax as a starting point. And then what comes after is the argument that says it's the lesser evil, particularly in this context. So I think that aside from our ideological discussions, an important point in terms of the context convenience of tax is to look at what empirical behavioral responses have shown in the last years. So I think that if you look at literature from the past, say, 5 years, including literature from Switzerland, from Spain, from Colombia, from some of the countries present here, is that this is a tax which does trigger behavioral responses. The individuals do react to it. They react in different ways. There's more elasticity in individuals than in firms, but individuals do react, and they react, for example, by shifting residence, which was one of your concerns. A lot of evidence from the Swiss cantons, precisely, shifting from the lower, from the higher end cantons to the German-speaking lower rate cantons. There's a lot of evidence of underreporting of non-registered assets, even in countries like Sweden, which no one would consider a high informality country. There's a lot of evidence of bunching near the thresholds. So a lot of people stopping right before the tax should start, which is an economic abnormality. And this happens in Spain, this happens in Colombia, both in companies and individuals. And there's a lot of evidence of recomposition of portfolios. So whilst we might not have evidence of a sort of intuitive effect of savings reductions, there is evidence of recomposition of the portfolio into either exempt assets, which might not be the most productive ones in a post-COVID context. And for example, Professor Overson was talking about art, one of the classic exempt shifters. It might be shifting into certain investment funds. In the case of Argentina, like you mentioned, you would see shifting into certain financial instruments that are exempted. Is that the most convenient in a COVID context when you want high productivity? Is it the most convenient in a COVID context when you want capital flow and working capital? Not really, unless you have a shareholder exclusion. So if I may share with you just for 2 minutes, a couple graphs so that we see it visually. I promise I won't be very long. It's just a couple graphs, I think, that really show some of the things that I'm mentioning, which are key to our discussion. So these graphs show the bunching that I was telling you about, right? So you can read about them later, but they show you in Switzerland, what you see is that after 1% drop of tax in rate, 43% increase in reported wealth. This one here shows you that years after the tax, you can see how wealth increases because people hide it when the tax is coming, which is here. This shows you that behavioral responses are quite different in terms of different individuals, wealthier individuals, a lot of evidence about that. And there's very interesting evidence of what I was telling you about bunching right before the tax. The distribution should be like this, but in reality it becomes like this because of the distortion of the tax. So serious evidence of distortion. That also happens in Sweden, huge evidence of bunching. And now, as to the COVID, I want you to think of two situations. Imagine that you were a shareholder in BP, petroleum, right? And imagine that you were a shareholder in Zoom. One of you was a winner during COVID. One of you was an utter loser. So if you had Zoom and you're taxed on net worth right at the end of the pandemic, here, you're going to be artificially taxed on a windfall that is not normal, that is attributable to COVID. On the other hand, if you're a BP shareholder, you're going to be taxed on an artificially low base because of a cyclical commodity depression. And this accentuates a problem with net worth taxes, which is that they're based on presumptions, not realized gains. That's one thing. A lot of you mentioned, Professor Robertson, Professor Ruiz, Almendral, a lot of you mentioned the issue of, is it really a situation where the returns of capital are high enough to not be confiscatory? Look at the case of Colombia. If you had a fixed credit deposit in Colombia, a 360-day deposit, the blue line shows you the return in percentages, effective. The red line shows you our inflation. The green line shows you the spread, so the real return minus inflation. And the purple line shows you the return minus income tax. So in reality, in 5 out of the 7 instances, it's below the tax. So it is being confiscatory, just with a very simple example. And this doesn't happen only in Colombia. Look at the Moody's seasoned yield for the whole world, and the emerging markets particularly bad. When you have COVID, you intensify liquidity traps inherent to net worth taxes, because you have real estate, and the real estate is not liquid in a crisis. You cannot sell it, and you're forced to sell it at a confiscatory price. If you don't have a shareholding exclusion, you also have an erosion of the financing pool, and I think Professor Zimmer talked about this. So negative impacts on FDI. You've got outflows particularly of younger people, and wealthy people, which means brain drain as well. And you've got a lot of issues with offshore disclosures, distortions. You've got issues with inefficiency in portfolio recomposition, and at least for emerging markets, very, very serious fluctuations in terms of valuation because of foreign exchange, temporary situations. I just wanted to talk about those economic effects. Sorry if I did it for too long.
I would like to raise one issue regarding valuation, which is cryptocurrencies. Cryptocurrencies generally did not exist when the laws were drafted. And Argentina, at least Argentine taxpayers, have determined that the cryptocurrencies are intangibles, and therefore they are exempt. In other countries where there is an exemption for intangible assets, how do cryptocurrencies are valued? How have they been valued? Because they do not have the problem of most intangibles that they are difficult to value. They're very easy to value.
In Norway, there have been a decision by a claims commission that found the cryptocurrency to be financial assets and not intangible assets. So it was subject to the wealth tax.
Oh, okay.
And for us,
I think that's the right conclusion.
Mm-hmm.
In France, it's an intangible asset, but as it is a movable asset, it is not included in the new wealth tax.
Okay.
So.
Yeah, in Uruguay, we don't have any kind of guidance by the tax authority, but because of the fact that in principle, assets that are located outside of Uruguay are not taxed. And regardless of how you categorize cryptocurrency, what we can all agree is that it's not located in Uruguay. So I think that's the way to analyze it. But it's a very interesting question in Uruguay for income tax purposes.
Oh, yeah. How about Colombia?
So currently we have a pilot, a sandbox with the tax administration and the financial administration, in which the policy is that cryptocurrency transactions are valued just as any other financial asset, meaning that because we don't have an intangible exclusion, you would be taxed on the spot value of your cryptocurrency, be it Bitcoin, Ethereum, whatever, at that day of valuation of the triggering of the tax, you would be taxed on the full value, regardless of realization, regardless of location. We are treating them exactly like any other currency. The virtual is yeah, that's the policy of the sandbox. But because it's a sandbox, we will see what the conclusions of the sandbox are, right?
But if you don't have an exemption for intangibles, that doesn't, the issue is not that important. I see. One other thing I see from all your presentations is that the political color of the government doesn't matter much. I mean, it matters in the speech. The center right promises to abolish it, the center left promises to increase it, but eventually they don't do anything, or they do very little, and that looks like a permanent feature of the government, that it is there is a resistance to get rid of this tax, or even to increase it. The tax remains more or less in the same way for many years, with some changes in tax rates, but apparently from what you said, the changes are small, or at least much smaller than what the government claims it wants to do. And one other thing that doesn't change much is the percentage of revenue over total revenue. In all the countries, it's approximately 1%, 1.2, 1.5, 0.8. Do you have any comment or idea about why is this? Because it looks very stable. I mean, it's a marginal source of revenue, but do you think it's about control for income tax purposes too, that we still use it and nobody wants to get rid of it? Because the control issue was something that all of you mentioned.
So at least in the case of Colombia, it was for control in 1936. It was for control in the 70s, in the 80s. But nowadays, like Professor Ruiz Almendral was saying, no, not really. Why? Because we also have alternative minimum taxes based on presumptive on net worth. We also have another alternative income tax based on patrimonial comparison. We have exchange of information with everyone. We have various third-party disclosure obligations, even advisors. So there is no way you're not going to be caught on your patrimonial composition, regardless of the existence of this tax in a modern or contemporary administrative system. You have intelligence, artificial intelligence, machine learning helping the administration. I don't really see that as a justification anymore. I think, at least in Colombia, it's ideological. It's about redistribution, equality, like what Marilyne was mentioning in multiple French periods. It's about whether you see a very high percentage of inequality and whether you believe in a Pikettian sense that this tax would sort of change the disparity between returns of capital and returns of labor, if you do have that disparity, which some countries don't. But I think here, it's not really about revenue. It's not really about control. It's a legitimacy issue, and it's about trying to balance the progressivity of the system. That it achieves that is a whole different issue, and whether it's fair, again, a whole different debate. But the other things are just excuses. At least that's my view.
Yeah, I think in Uruguay, the control issue is also sort of an excuse at this point, but I wouldn't even say that it's an ideological issue here even. I think it's been here, it's been in place for a while. It's not a significant source of revenue, but it's also not negligible. It doesn't really create sort of a resistance. So it works. It's not the best, but there's not a politician who would want to take it out. I mean, the benefits of taking it out wouldn't make sense. I think that's just it. It wouldn't be implemented now, probably, but now it's there. It's been there for decades, and that's it. There's not an incentive to really change it or to really analyze whether it serves the purposes it's supposed to serve.
In France, I think. Oh, sorry.
No,
I think in France, I think the issue is that it's a real problem of what do you mean by capital tax? I mean, what is the aim of the tax? And the problem is that it's a question of fairness and tax justice. So maybe that's why it's very difficult to just to change or to delete it. You have asked a question, Maximiliano, in your presentation that is on this tax shield of the cap wealth tax. What is the good threshold? This is a really interesting question, in fact, because in France, we have a lot of constitutional decision on that. Just to ask the question, what is the maximum marginal rate a taxpayer can bear? And that is the question. If you add some taxes like that, you have to raise the question, what is the maximum total income tax you can bear? And so it also raised the question of, if you would like to say if a tax is confiscatory or not, you have first to put this tax in a global system. I mean, you have to put the tax in its context in order to combine it with other tax rules that you have, and just to see if it is too much or not. And after, I think there is no absolute threshold at which a tax rate becomes confiscatory. For that, maybe there is a different assessment of the confiscatory nature of the rates, depending on whether they are applicable to the whole of an item of income or to its marginal fraction. So maybe it questioned the logical of the whole system, and that's why it's difficult just to change one thing.
In Argentina, there has been some problems regarding the calculation of confiscation of taxes, regarding the mixture of national and provincial taxes. Because if the sum of them is confiscatory, which one of them should be reduced?
And which one?
But at least in regarding personal assets tax and this extraordinary tax and income tax, they are all national taxes. So in the current situation, this should not be a problem. But what could be a problem is that there is no case law so far saying that the tax should be, which taxes should be added to calculate a confiscation. For example, you can add this extraordinary tax on wealth and the personal assets tax in Argentina. But should income tax be added to them for calculation? I mean, Argentina, there's no case law. I think, well, we don't have a German in the panel, but I think the Constitutional Court in Germany said something that confiscation should be considered tax by tax. But just Marilyne, that's the case.
I think it's the Karlsruhe case, no? Maybe.
I don't remember the name, but I think that issue was treated by the Constitutional Court in Germany. Norway does it have it on a constitutional court or a court that can declare a tax constitutional, or Frederik?
We don't have a special constitutional court, but the Supreme Court, which is a general court, can declare laws, statutes being contrary to the Constitution. But we have very little tradition for doing that in tax cases. So, of course, the issue of confiscatory taxes has been raised, and earlier we had a kind of ceiling on the joint effect of wealth tax and income taxes, which was about 80 or 90% of the income. But we don't have anything like that at the moment, and I think that is partly due to the fact that the tax rates have been lowered in the late years. So, but I think the short answer is that yes, there's a constitutional control by the court, but it's not very practical in tax cases.
Okay, and much less in wealth tax cases then.
Yeah, it's only on one subject, that is on retroactivity. Then they have some substance.
I see. Okay.
And may I ask you a question, Professor Zimmer?
Yes, certainly.
I just would like to ask, you have mentioned that the inheritance tax has been removed.
Yes.
Are there some discussion on in parallel with the wealth tax?
Yes.
I mean, yes, it was for that, because in France we have the same. So we have this discussion.
Yeah, it was the incoming conservative or center-right government 7 years ago which abolished the inheritance tax. One of the first things it did, actually. But then, if you have a shift in the political power, it's difficult to say what happens, because the Labour Party, which is the biggest, they are very reluctant to reintroduce it. But the more left parties, they are eager to do it. So it may come, and some people are very worried about that. I myself actually argue that the right thing to do would be to have an inheritance tax and no wealth tax. And one reason for that is contrary to what I heard from some of the countries here, that I think it is easier to do good valuations once time in a generation than every year. So you can put more force into the valuations when you do it more seldom, and you can get also the intangibles into it in another way. So, and of course, you see also on the world basis, there are more countries with inheritance taxes than with wealth taxes, actually.
And are there some discussions to reintroduce it?
Yeah, some of the parties that may be part of the government after the election this autumn, they want to reintroduce an inheritance tax. But the Labour Party, which is far the biggest, they have been reluctant, at least up to now. So the discussion is beginning, and people are preparing for that in a way. Thank you.
So yeah, the relations between the wealth tax and the inheritance or the state and gift tax, they are very close. Actually, as I mentioned, in Argentina, the wealth tax evolved from difficulties in the administration of the estate and gift tax.
Interesting.
Actually, if both of them do exist in the same country, I would say that there would be a double taxation, a very burdensome double taxation.
Well, that's a big discussion. I agree with you, but that's yeah. We had wealth taxes and inheritance taxes for a century, side by side. So
I see.
It was never challenged, I think, as a kind of double taxation issue.
So the main thing is that you have low rates for both of them.
Yeah, certainly. Yeah. Well, the inheritance tax have been higher, but they ended up to be quite low before the abolishment.
Nice. How about do you have this double both taxes in Colombia, Diego? Or?
Yeah. So in Colombia, inheritances are taxed under capital gains or occasional gains tax at a 10% flat rate. It has some exemptions, for example, for main dwelling or for housing, really, and a certain blanket exemption for the first X thousand million or X thousand pesos of your inheritance. But in reality, I do agree that in an ideal world, you would want an inheritance tax over and above a wealth tax, also because the double taxation doesn't happen on a cascade every single year. It happens at the end, and it achieves intergenerational distribution purposes, which are, I think, find more support in economic literature than tax for the person that generated the wealth, rather tax the person that didn't earn it or didn't have any merit in obtaining it other than the lottery of genes. But so personally, I define myself as a Rawlsian. I like Rawlsian theory, and I do agree that it's fine if you didn't have the merit to be taxed. But if you made this money, questions become different in what Professor Sadowsky was arguing about fairness. There really are very different angles at analyzing inheritance tax, but we do have both. So at the moment, you're taxed A, on earning the money, B, on consuming it via VAT or transfer taxes, C, on enjoying it, property tax, which is very high in Colombia, and then you're taxed on your debt and on the wealth every year. So it's an issue of the cascade and how much that impacts your overall pressure, your fiscal pressure, which becomes problematic. And to complement your discussion or supplement your discussion with Professor Sadowsky about confiscation, our constitutional court has said that you need to analyze two separate things: systemic effects and tax by tax effects. And they do both analysis. So for example, whenever someone says that a tax is not progressive, they say a tax itself might not be progressive, but if the system is progressive, that's fine. Similarly with confiscation, a tax's confiscatory effect, if ameliorated by the system, might be okay, which I don't agree with, but they do have that idea of trying to balance systemic effects with specific effects on each tax.
Yeah, well, confiscatory taxes may be, or I mean, at face value, may have the confiscatory effect reduced by operation of exemptions. For example, in Argentina, the personal assets tax has been the most, the lower tax rate, which may result in confiscatory effect, is mitigated by exempting some assets, some types of assets, which of course creates incentives for investing in those kind of assets, your own house and government bonds and the like. So when, for example, we think about this percentage above which the tax is confiscatory, in the case of the income and the assets, the income, assuming that the comparison is with the income, we should consider all the income, including the exempt income. And that's could be a main issue, because when you make the calculation, it turns out that a good part of the income could be exempt, and then the assets tax, or that is not that confiscatory as it looks. It could in the end result as confiscatory, but it depends on whether the income is exempt or not, or maybe, for example, subject to a lower tax rate. For example, capital gains, which generally is subject to a 10, 15, a lower tax rate than ordinary income. So using the confiscatory argument requires a lot of definitions about the tax basis. And so, yeah, sure.
No, sorry, I mean, you are right. I think you have to take it's not illogical to take the two bases, the wealth tax basis and the income base, income tax base. Sorry. Yeah. So sure. And I think there is also another interesting difference is the way that countries are going to recover the COVID debt. Because in Argentina and in Uruguay, you have mentioned that government has decided to create some specific taxes. It's interesting to see that on Uruguay, the effort is going to be put on the civil servant. And in Argentina, it's a different things. In France, we are going to implement a recovery plan. It's a very huge plan. It's 100 billion euros. And it's interesting to see that to finance it, we have a part of from the EU. We have 40 million from the EU, and after that, some loans. So I think it's very interesting to see also how countries are going to deal with that in the future, and to see that in Uruguay and in Argentina, you have some specific taxes to cover it. So it's just a remark.
Yeah, well, it sounds like in countries which have more credit than Argentina doesn't have it, so it has to raise taxes now. You'll have to raise taxes in the future to pay the loans or pay the money you are spending right now, which has been borrowed.
Uruguay is definitely gonna make use of its good credit. Sorry, Maximiliano, but it's better credit than
almost everybody has better credit than Argentina.
Yeah, I know. I know, but definitely that's the way that this is actually going to be financed. This tax that I mentioned on the salaries of the public servant, it was more of a token and a signal by the government than actually relevant in terms of the collection and to really get the funds that are going to be needed to then front the crisis that we are experiencing now, that we are going to keep on living for I don't want to say how long, but not for the next 4 months, which is when this tax is still going to be applicable.
I think there, just to remark, Colombia actually enacted a tax on public servants' salaries and also public pensioners. We did it under extraordinary legislation earlier in the year, and the Constitutional Court declared it unconstitutional because it violated the principle of horizontal equity. They said, oh, well, if you're in the private sector and you have the same ability to pay, you're not paying, this is unconstitutional. And it fell. So now they're trying to give tax as an ordinary legislative measure, but now they're saying that they're going to impose it on everyone. Since the Constitutional Court said it's not good that you do it only for those, then let's put it on everyone. And we'll do it on everyone who has income, including pensioners, contractors, salaried workers who earn above, say, $3,000 a month. which would be considered high income here. So we do have a history of that type of tax.
That you're preferring a tax on income and on salaried income because it's the safer one. It doesn't fluctuate as a means of covering the gap between revenues and expenses because of COVID.
Our special tax has already been challenged before the Supreme Court on constitutionality grounds because of the case law from the Uruguayan Supreme Court. It should not be ruled unconstitutional because essentially they've accepted that every categorization is rational and that and there is a lot of case law from the Supreme Court, and so it's been challenged. We do not expect the Supreme Court to rule that it is unconstitutional.
Wow.
There is also a proposition made by the economist Thomas Piketty to create, a global minimum mondial tax that is in discussion now in France in order to introduce the idea of an international solidarity. And we have also on wealth all the proposals I have not mentioned in France in the slide. Hollande, for instance, proposed to create a new tax on high incomes for the part of dividends. We have also the transformation of the new wealth tax just to focus on unproductive wealth. So we have lot of discussion about that on the transformation on what about the wealth tax now, in fact, and in the future for the world.
It sounds that wealth tax and salaries tax, in a world of crisis, well, a normal tax on income wouldn't yield that much because most people earn less income. And so they're going for the safe thing, just capital, because capital does not reduce its value. Most capital doesn't reduce its value, especially if you consider it at the normal tax basis, or salaries, because especially when you have laws, as in Argentina, that you cannot terminate employment agreements, salaries are also a stable source. I mean, it's not reduced by the crisis. Yeah, so that looks like a common pattern, and yeah. So, any other comment? No. Well. Thank you very much to all of you. Unfortunately, Violeta and Xavier had to leave early. But this has been a very interesting panel, very interesting presentations, a great comparison that are thought-provoking. And thanks for your time and your very clear explanations. And thanks for the audience too for this almost 3-hour panel. Which was great to share with you.
Thank you.
Thank you.
Thank you very much for the invitation.
Thank you.
Bye-bye.
Have a nice day.
Bye.
Bye-bye.
Bye.
Bye.